All right, let's dive right into this explainer. Today, we're going to try to reverse engineer the staggering multi-billion-dollar collapse of the RaveDAO token. We'll be looking at how a project that actually aimed to bridge real-world live entertainment with Web3 technology experienced one of the most violent market reversals in recent history. It's a fascinating yet completely cautionary tale that perfectly illustrates the hidden mechanics running beneath crypto markets. Just imagine watching $6 billion, yes, billion with a B, in market value completely evaporate in just 2 days. Well, that is exactly what happened to RAVE. You really don't see this kind of absolute destruction every day. We're talking about a total liquidity collapse here, where buy bids just vanished into thin air, leaving retail investors trapped in an absolute free fall. And this timeline brilliantly shows just how violently things shifted. I mean, RaveDAO had been on an absolute tear, boasting this euphoric 6,000% monthly rally. On day one, it hits an all-time high of nearly $28. But then, by day two, prominent on-chain investigator ZachXBT posts allegations of market manipulation. And by the end of that exact same day, the token aggressively sold off, crashing to below $1.50. A mere 48-hour window is literally all it took to dismantle months of parabolic momentum.
Section 1. The Vision, a decentralized live nation.
Now, to understand why this crash was so incredibly shocking to the community, we first have to look at what RaveDAO was actually building in the real world, because this wasn't just some meme coin, right? There was a genuine business model at play here. There's this really stark contrast between their utopian, philanthropic mission and the brutal reality of their token's market mechanics. On one hand, you've got a project hosting massive electronic dance music events globally, places like Dubai, Singapore, Amsterdam, drawing over 100,000 attendees. They even had a philanthropic arm called Rave for Light, which successfully funded hundreds of cataract surgeries over in Nepal. And then on the Web3 side, they were pioneering NFT ticketing and decentralized governance.
They literally positioned themselves as the TEDx for music. According to their own white paper, local organizers around the world would stake RAVE tokens to license the brand and spin up their own city-specific chapters. It's actually an incredibly ambitious B2B staking model, completely designed to create organic demand for the token while decentralizing the live event industry. Section 2. The Hidden Mechanics. On-chain red flags. So, how does a project with sold-out events and real tangible charity work implode like that? It really all boils down to one concept: low float. When only a tiny percentage of a cryptocurrency's total supply is circulating publicly, its price becomes highly vulnerable to manipulation. As crypto analyst Coach Miranda Miner brilliantly explains, manipulating a low float is kind of like controlling the flow of a small river, which is infinitely easier than trying to control a massive raging ocean. And here is that tiny river visualized for you. Out of a maximum supply of 1 billion RAVE tokens, less than a quarter, just 24.8%, were actually circulating in the open market. The rest were completely locked or unvested. And this creates a massive discrepancy. Because when the circulating tokens push the price up to almost $28, it gives the project a fully diluted valuation, or FDV, of over $14 billion. That is a major dilution risk hovering right over the market. But the absolutely crucial point here is the extreme concentration of wealth. A staggering 99.9% of the supply was held in just 25 wallets. Even more alarming, about 90% of the total supply was held in just 3 Gnosis safe wallets, which are widely believed to be team-controlled. I mean, this gives an incredibly small group the absolute power to dictate the market. If even a fraction of those holdings are moved or sold, everyday retail investors literally stand no chance.
Section 3. Anatomy of a squeeze. Fueling the fire.
Now, let's see how this low float and extreme concentration created a literal ticking time bomb for retail traders. Because you see, it wasn't just regular spot selling that crashed this token, it was the derivatives market. $43.68 million, that is the massive amount of leveraged trading positions, mostly shorts, that were violently liquidated in a single 24-hour period. At one point, RAV was the third most liquidated asset globally, sitting right behind Bitcoin and Ethereum. Here is the exact anatomy of a blow-off top. Step 1. The low float heavily restricts the actual tokens available to buy. Step 2. Speculative volume starts pouring in, and as the price ticks up, bearish traders who bet against the token are forced to buy it back to cover their short positions. This creates a massive short squeeze, artificially skyrocketing the price to the moon. But then, Step 3 hits. The upward momentum eventually stalls out,
Because the liquidity was always razor-thin to begin with, the buy-side bids just evaporate. With no one left to buy, the price falls right into a void, triggering a reverse liquidation cascade that destroys the token's value entirely.
Section 4. The Aftermath, Allegations, and Denials.
With billions of dollars in market cap completely wiped out, the crypto community naturally wanted answers about who was actually responsible for pulling the trigger. Prominent on-chain sleuth ZachXBT publicly alleged that this was a highly coordinated pump and dump. He pointed to the massive wallet concentration we just talked about, alleging that insiders used major exchanges to engineer that massive short squeeze before exiting near the top. He even went as far as offering a $25,000 bounty for whistleblowers to come forward with inside info.
Now, in response to this, the RaveDAO team strongly denied any involvement in the market manipulation. In a detailed official statement, they claim they are not responsible for the price action at all, framing the crash as just external industry noise. They maintain that their focus remains purely on their real-world mission of bringing mass adoption to Web3 through live events, and stated they wouldn't engage any further with the rumors.
To keep things completely impartial here, we have to note that the exchanges themselves have stepped in. 3 major global platforms have officially launched active investigations into the trading behavior surrounding this crash. Binance's Richard Teng, BitGet's Gracie Chen, and Gate.io are all actively probing the origin of the pump and the subsequent liquidity collapse to determine if any actual market misconduct occurred on their platforms.
Section 5. The Takeaway, Lessons for Retail Traders. So why does all of this matter, and what should you, as a focused learner, take away from this multi-billion-dollar autopsy? Look, whether a project is funding global charities, throwing the absolute best parties in the world, or has a brilliant white paper, retail traders must always check the on-chain metrics. You've got to compare the fully diluted valuation against the actual circulating supply. You absolutely must check for extreme token concentration in the top wallets using on-chain explorers. And finally, as Coach Miranda points out, organic growth rarely looks like an 11,000% spike in a matter of days. If the liquidity is thin and the leverage is high, you are stepping right into a trap.
It is a multi-billion-dollar question that leaves us all wondering about the future. I mean, RaveDAO proves that real-world utility and Web3 integration can actually happen. They have the attendees and the revenue to prove it. But can that real-world utility ever truly survive in a highly manipulated, poorly distributed market ecosystem? Keep these red flags in mind the next time you see a chart going parabolic. All right, thanks so much for joining me for this explainer, and keep learning.